All right. So today's agenda is I talked a little bit about reasons for success and failures in trading, why traders fail and why they succeed. And I do gap trading. So people ask me questions on gap trading. I have written a detailed document on gap trading. I have I send you email from time to time. It describes all the steps, how I do gap trading. There are four types of gap trading I will talk to you about. That document is in the guidebook. So if you sign up, whether as a free newsletter or a paid member, that book has article on gap trading. And I trade gap all the time. Every day there are some stocks gapping up and down, and then I trade. I may not trade the gap the same day, but I watch the reaction of the gap next day or the day after. So like 1 or 2 days, I watch those stocks which gap down or gap up. Also, I pay attention to the gaps for support and resistance. So I know where is the support, where is the resistance based on the gap. I try to evaluate that because gaps tells you where is the support, where is the resistance, why the stocks are gapping up, whether the gap will be filled or not filled, what will happen. And after the gap, is it a gap fade or gap continuation? It will reverse or not reverse. So where is it gapping? Is it gapping on the support level? Is it gapping at the resistance level, above the resistance level, below the resistance level? So what is happening? So I monitor all this during trading hours, and I have a grip on it. So I love gap. So that's why I decided, okay, I'll teach a little bit about gap trading. It's a big topic, which I cover in my 6-month coaching program, but this is just a glimpse. So uh, you will still understand it, but there's a big topic on gap trading. And then I will show you some technical analysis stocks. Last week we did, and some trades are open. So let me move forward. So this is agenda. So success and failures, gap trading, and technical analysis. And I'll show you some charts of the stock markets, the 4 charts I do. And the market has given a major buy signal. The market is moving up. So and I'll show you where the resistance levels for and which market is the leading market right now, I think. So all right. So now this chart, success and failure in the market. This chart tells you the percentage wise how many traders succeed and fail. So take a look at this blue pie. The 70% of the traders fail in this business. They fail, and most of them wipe out their account. So 70% of the traders wipe out their account, and the reasons are simple. They have low capital. They start with $2,000, $5,000. That's not enough. I started with $2,000 back in 14 years ago. First trade was the profitable trade. I had no clue how to trade. I started trading options. That was a disaster. I shouldn't trade options in the beginning when I don't know how to trade stocks. First, I need to learn how to trade stocks, understand the market. Then later, I should switch to options. But I switched to option right away. And first trade was the winner. That was bad also. When your first trade is a winner, that's a bad sign. So my first trade was a winner, and then after a month, I lost $2,000. It was gone. So I could have been into this 70% of the failed traders, but I took some action at that time. I found mentor. I realized that I need to take action. So I took some actions at that time, and I dedicated myself, became passionate. I acquired skills, knowledge, experience, and I spent time, 14, 15 hours. I still spend time. I spend time. And the way I move forward is I ask questions. If something fails, then I ask questions. Why this thing is failing? What is the solution? So I look for the solution till I find the solution. When the solution I find, and I write it down that this is the solution. It's like, I'm sure when Colonel Sanders was preparing his KFC chicken, I went to KFC the other day, and they had a posters of in Thailand. They had a poster of Colonel Sanders preparing recipe, and he had written down all the recipe, and he's crossing it and then writing it down, crossing it, writing it down, and then finally he came up with that recipe and he gave it to his daughter. He put the recipe on top of the door and said that if something happened, here is the recipe for my chicken. So the recipe in trading comes, you just start writing down the solution, the problem, the solution. But 70% of traders, they think they can do it themselves, and they don't have time. They just look at the tips, tricks somewhere, CNBC, Facebook, and they try and they wipe out. So 70% of the traders wipe out their account. 18.5%, they are the one who's break even after a few years of trying. They just end up being in a break even, which is good, not bad, but then they give up. So only 11.5%, only 11% people succeed and move forward in trading. So imagine out of 100, only 11 people are succeeding and 89 are failing. 70% are the failures. So why they fail? Poor money management. It's not about the entry and exit. People just focus on entry and exit of the trade, and then they think, okay, if someone can tell me how to buy and someone can tell me when to sell, I'll make money. No, that's not it. That's only 30% of the system. 30% is the entry and exit. The rest is how you manage the trade, how you managing all your trades. I see it. People buy 10 contracts. Doesn't matter if it's Amazon or it's a little stock like AKS steel trading at $5 or $10, or Amazon trading at $1,500 or $2,000. It doesn't matter. They just buy 10 contracts. So that's the recipe for disaster. Another thing they do is, doesn't matter what condition of the market is, they just keep trading the same amount. That's not right. When the market is bad, they need to come down, bring the exposure down, right? So they don't do that. It's like the other day I was kayaking. So I learned kayaking and the waves were up and down high. So my teacher was telling me, okay, you need to do this. The waves are coming, do this. Waves are down, do that. Turn right, turn left. So same thing in trading. The waves are coming, right? In the market, it's the same thing. But people just go on the same speed. They doesn't matter if the market is bullish, bearish, mildly bearish, or choppy. They are putting the same money. It doesn't matter how many open positions they have. They put the same money in the stock. It doesn't matter how many loser trades they had previously. The next trade they put on is the same dollar amount. So if you have a loser trade in last 1 week, you had 2-3 streaks of losing trade, you need to cut down till you bring your winning streaks. Or if you have a winning streak coming up, then you have to accelerate. There's something going on that you suddenly started having a winning streak. It's not your technical skills improved over time, and now you become a master. It's not that. It's the market. So the market has become good. The market is saying that suppose you are bullish, the other stocks are buying. It's not you only who are making money. There are other traders also making money. So look around, ask some people what is happening. Why am I making money? So if you're making money, you need to accelerate your exposure per trade. And if you start losing, you bring it down. So and follow the stop management, position sizing. So all this is a money management, and traders don't do that. They just keep in the same rhythm, and then they drown. So gamblers fallacy. If they lose, they double the bet. So if they lose 500, in order to make 500, they say, okay, I'm gonna bet 10,000 or $2,000 to bring that back. They don't have discipline. They just they don't know where to enter, when to exit. They don't have any guidance. So they're just trading alone. They don't have any guidance. They don't believe in mentorship. Ask questions with someone. They don't even have experience. Yesterday there was one lady who joined. I don't know if she's in the webinar. So she joined a swing option service. So the first question she sent, I read that question and I knew that she doesn't have experience. So I asked, how much experience you have? So she said 3 months, and she didn't understand the stop. I had written a stop. The stop will be below 322. So she did not understand what does it mean by stop below 322. So I asked her, hey, how much experience you have? Because you're asking me this question. She said 3 months of option trading. So now I mean, it doesn't matter how great of a trading alert services you provide, her result will not be the same as compared to the person who is with me and who has been trading for 5 years, 3 years, 10 years of, have experience, have gone through all the shit, and he knows. And then when I send the alert, I understand what's the stop and can manage. So there's a difference between that 3 year experience lady and a person who has 10 years of experience under his belt. So lack of experience. And why traders succeed? Because they spend time. So they spend time, they acquired knowledge, they found a mentor who provide a solution. They have experience, whether real or simulation. Simulation is just one part, but they do have a real experience of trading. And they receive guidance. So they have someone who can guide them. So that's why these traders succeed. All right. So now I tell you how professionals make money in stock market. I show you some slides and some of my chart. And professionals don't make money like the retail traders are, try to make money, chase the stock on the top and go short at the bottom. That's not the way the professionals, they come in right at the bottom. And before you realize it, the stock has moved up and gone to the moon. That's where the retailers are trying to buy. So professionals don't do that. Professionals make money in the market in a different way. And they have practiced few techniques. Like I keep telling you, I have practiced few techniques, and I believe in this Bruce Lee quote. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So I have practiced one kick 10,000 times. It's the same techniques. I use not just one, so not the exact like one technique. I have few techniques, and I just use those techniques. That's the setup I have when I'm traveling. With the laptop, all the resources are compact. So I don't have 15 monitors like I have in San Diego. Even in here, I have 7 monitors. But when I travel, I have 3 monitors. Sometimes I'm traveling, I only have one laptop. So I don't have even another laptop or another monitor. So all the things I pack is in one laptop. That's the key laptop where only the important things are there. The kick is there. So I turn on the laptop anywhere. I can sit in a Starbucks or any cafe here. The Wi-Fi is everywhere. I turn on, that kick is in that laptop, and I just use that one kick. But if I have to more kicks, then I open other laptops and the screen, and I do that. Otherwise, I don't. So I practice few kicks, not like go to commodity market and learn forex currency and trying to trade 8,000 stocks. Uh, Sometimes AMD and GE and AKS, the stocks, they don't move. No, you just prepare a basket of 300 stocks and you just focus on those. They are the one moving. At least something is moving today out of those 300 stocks. If you look carefully, even you need 100 stocks. If you look carefully, you will find something which is moving, which will make you money. So master the technique which produces high and fast return. Now I have 300 stocks. Actually, I have 600. Then I have a core stock. So the core stocks are 300. So when the market opens, I have built a system out of 600 stocks. They are flying. Some are flying to the upside, some are flying to the downside. So how do I cash cash the one which are just moving? And when do I catch? What is the time? Do I catch when the market opens right away, or do I wait for 1 hour? When is the time to cash that stock, which will give me a fast and high and fast return? And what should be the technique? So master that. The stocks which are about to move, or they're at the beginning stage of the move, not at the late stage, and there is a potential left in the trade. So when the potential is left in the trade, and you have because you need to have a potential in the trade, especially when you're trading option. If you don't have a potential, then there's a slippage on your side. So when you're entering the trade, you may enter late. The spread is wide in option. When you are exiting, the spread is wide also. So let's say in the option, So you miss that, you're not getting good price, and maybe the stock moved $2, and by the time you see the stock has moved only trading at $1.50 high, net change, so 50 cents you lost over there. So all in all, if the range of the profit is narrow, you may end up breaking even or low or losing it. So you need to have a potential in the trade. So and there is a catalyst behind the trade. So there is something going on behind that stock. There has to be some news, positive or negative, either now or it's coming or expected. So the stock chart is telling you that there is something going on. So there has to be a catalyst. Otherwise, you can sit like a big boys, and they are the one who buy based on fundamentals. They know why the stock should move up. So they have done their research. They identify that stock, and then they just sit. And then they are the price makers. So they just sit. And then later, if you want to sit with them, you sit with them for like 3 months. The stock is doing nothing. But since we are don't have that big capacity fund wise, so we need to identify the trade which moves fast, and give us a quick return. So this is the chart I prepared. So people say there are two kinds of analysis: fundamental analysis and technical analysis. So fundamental analysis is all related all to the company related data like price, the cost of the product, the sales growth, their different ratios, what the sales they are projecting, what revenue they are projecting, what it would be the cost, what would be the distribution, how they will distribute, and what market they penetrate, what is the good growth rate. So all this new products coming or the company is maturing, etc. All these analysis go into fundamental analysis. That's where when I was doing MBA in finance, I was trained to do that. I changed. I almost became an investment banker, but then I switched and became IT consultant. So I became IT consultant, and because of my analytical skills and computer skills, I changed my profession. But I loved. Eventually, I came to stock trading. So the fundamentalists are those, right? And then on the technical analysis side, they study the market related data. So they believe that everything what the stock is telling you is there, right there in front of you on the chart, or what is about to happen. So if you understand the chart, you would know what will happen to the stocks. So they don't need, they say they don't need fundamental analysis, right? So it's good if you understand the fundamental of the company and you are expert in technical analysis, and then you combine those two. So that's called rational analysis. So this is a juncture, this is a common point of those two areas. So if you understand, you do some research on, I suppose Apple is coming up with new products or services or whatever is going on, and the stock is pulling back, and you time your entry based on technical, because you know that Apple products and services good. They are coming up with new product announcement and the sales will be good. You did some research. You're not expert in fundamental analysis, but you're good at, you have access to those who are expert. And so you read some news, some report. So you combine that, and you are expert in technical analysis. This is where you combine. When you combine, it becomes rational analysis, and you become a solid trader because you believe in fundamentals and you timed it with technical analysis, and this is where you come. This is where you make money. If you are here, if you're here, you need to be, it's okay. You're timing your entry, and then you're believing it that the chart is telling you all the fundamentals, why the stock is moving. So if the Apple is moving today, why it's moving? It gapped down yesterday, but it's moving up. So what is going on? So it's like that. NVDA came up with the earning, and now it gapped down. And why gap down? And now it's moving up. It's filling the gap. So you know they came with the blockbuster earning, and the gap down and moving up. Okay, I buy it. So this is where you come. All right. So there are three types. I mean, not three types. There are several kinds of trading types. So I am basically swing trading, and I am below here, swing trading position in long term. So scalping, the scalpers are, they scalp 10 cents, 5 cents a day, not a day, per trade, several times, 10 minutes, 15 minutes, every 10, 15 minutes, they are scalping 10 cents, 8 cents. They buy a lot of shares, like 5,000 to 10,000. They are putting all their money into one or two trades in a day, and they just keep scalping 8 cents, 10 cents. So for scalping, you need to be very precise from entry and exit point, because you're putting too much dollar, too many shares buying and spending a lot of your capital on it, but you're making money every day scalping. So 8 cents, 5 cents, 2 cents, and then it adds up. So they meet their profit objective. Day trading is the guy. So the more you move to the downside, the more experience, the less experience you need, and less precise you need to be as you move down. So, and for scalping, you need to be very precise from entry and exit. You need to be expert. Day trading, then less precise. So day trading, you buy and then you hold and you close out your position at the end of the day. So that's what you were expecting. You make money or you don't make money, but you're expecting that, okay, I'll buy this for 50 cents, 60 cents, 80 cents profit, whatever is your objective. So that's day trading. The swing trading is in between. In between, the swing trading means anywhere from 1 to 7 days hold. So it's a quick turnaround. So it's a quick turnaround for swing trading, 1 to 7 days or 1 to 5 days. So that's where we trade. Position trading is anywhere from 1 week to 1 month. You hold your position. So I do this also in some trades. Position trading, both options and shares. And in my retirement account, I have a long-term investment. So I have Nvidia, Apple, Facebook, all these types of stocks in my retirement account. So long-term investing. So in long-term investing, I have a quality stocks. So basically, my is swing trading. So why swing trading? Because it's a combination of two concepts. So it's you combine it with the slower pace of investing and a quicker pace of day trading. So it's in between. You are not closing the trade. You can close the trade same day, like we did on Friday. Not Friday. Today is Wednesday. So I mix up because right now it's Thursday here and over there it's Friday. So I have to switch my mind. So it's Wednesday, yesterday, or for you it's today. We traded cost calls and we closed the same day. So the swing trading becomes day trading, but it's okay. You made money, it's okay. And sometimes the swing trading become a position trading, because if the trade goes on from 7 days to 8 days, 10 days, it doesn't. The stock is sitting in one position and it's not giving exit signal also. So the swing trading is in between the two, day trading and investing. So that's what I like. And the objective is to maximize profit in short period of time. So that's the objective. So if you believe in the compounding effect, return on money. So the quicker you turn around your money, the quicker your portfolio is growing. So if you hold the stocks from 1 to 3 7 days and you make 2 3%, then you another 1 2 3%, another 1 2 3%. So the effect over the month is huge, and you minimize the downside risk. So you know clearly where your exit is. Or when you're putting on the trade, you should know the exit. Whether your exit is based on the technical analysis, that's where I do, or you just say, okay, if I lose 50% of my capital on this trade, I will get out. That's your exit. Another exit could be time-based exit. So if you say, if the trade doesn't work for 10 days, I will close. It doesn't matter if I'm losing or not losing, break even, time-based, that's my exit. So I exit after 10 days and move on to another trade, because there is an opportunity cost. So the longer you hold to a position and not making money, there is an opportunity cost. You don't have unlimited capital. The capital is limited, and if the capital is not working, you are not progressing. So that's a time-based exit. So return via swing trading. So if you trading stocks, your objective is to make 3% to 7% within a week. or sometimes 2 days, 3 days. So that's your objective, 3 to 7% return of swing trading stocks. Now, when you combine that return, convert into option. So if you're trading option and if you time it right, the return on option trading could be 40 to 100%. So that's where the option comes from. So first you need to master the stock trading. This is what people do. They just go and take $20,000, $50,000 courses from different institutes who are just training them option, different strategies, but they don't have any clue how to implement that strategy. So how can you implement option strategy when you don't know where at what cycle the stock is, whether it's going to go up or going to go down or sideways, what is happening? If you don't know that, and you became master of option trading, I ask you about iron condor or butterfly, and you will give me all kinds of details. Then the last question I will ask is, okay, please give me one stock where I can put iron condor, and then you quiet, or butterfly, or even just a call, just one stock. Can you name me one stock with the target and stock and tell me what to do? Then no answer. So that 50,000 or $100,000 training is no good. So the training should be, you should master the stock trading and understand the markets and understand the money management, position sizing. Then if you want to trade options, then you trade. Or if you don't know how to trade options, then you take help from someone. If you don't know how to learn stock trading, you join some coaching program. So hire a mentor. I hired a mentor in business related, not technical, last year, and I see the result. They know their stuff. So swing trader tools. They another thing. People ask me, what indicator do you use? When I tell them I don't use any indicator, they don't believe it. Now my coaching students, they're believing me now because I'm showing them every week how to trade and how to make money without any indicator. You don't need any indicator. You can use some indicators if you find it works, but first you need to build your core skills, which you can use 50 years from now. It doesn't matter 100 years from now. People are using it for 400 years. So once you develop your core skills, then you put something on top of it. So you build. It's like designing a house. First you need to master the architect. If you're not an architect and you can keep designing and building your house. It will be like a shoebox. Looks like a government built by a government. The building will look like that. It won't look like a built by an architect. So it's the same thing in trading. You can keep on hunting indicators and studies, but if you don't master the core techniques, then it's not going to work. So in other words, no need for perfect indicator. Identify the proven pattern. So you need to identify the patterns which work in the past and which will work in the future. So what is the reliability of that pattern? What is the consistency? Are they rare or they appear quite often? And when they appear, what is their failure rate? What is their success rate? When they succeed, how much return they give you? When they fail, how much they fail? So all this you need to know for each pattern for your skill. And then when you're taking the trade, then you know, okay, this is the data telling me that this pattern is successful this many time, fails this many time. What should be the market condition, whether market should be bullish or bearish or choppy? Can I take this trade? It's a bullish, looks like bullish, but the market is bearish. Can I take the trade? Will it be successful? What is the failure rate at that time? So all this, if you master, then you are comfortable, and then you execute the same techniques daily. So you execute again and again and again, same thing, same old thing. You just turn on your computer, you find that thing, and then you trade. You use your judgment and skill because you are based on your past technique and experience. You see that and you know that this is the stock will do. If it doesn't do that, there was something wrong, and then you just move on. So you build your skills, your expertise, you exercise flexibility. So don't be rigid, like always buying 10 contracts, always putting on the same dollar amount. No, even same dollar amount doesn't shouldn't be there. You say, oh, I don't buy 10 contract, I always put equal dollar in each trade. That is also not right. It depends on the market condition. Do you know what kind of market it is? Do you know what is happening to your portfolio? Do you know how many open positions you have? Do you know any other event coming in? Is there a long weekend coming in? Is there some major announcement coming in? So you have to know all that. Do you know what the markets are doing, indices are doing? Are they facing resistance, support? Which one is leading? Which one is lagging? What could happen? All this, when you combine and you stack your probability in your favor. So you don't need perfect indicator. This is the key. You don't need perfect indicator. I'm proving it to my students. No need for perfect indicator. Okay. So uniqueness of swing trading. So what is swing trading? So the swing trading comes when you identify the trade before crowd identifies it. So when the crowd identifies it, that's where you are tightening your stop and getting ready, rubbing your hand and getting ready to exit and setting your sell order. So technically, the stock tells you the stock is about to move, and you position yourself. You can position yourself maybe 1/3 of your dollar allocated, and then when the stock starts moving, this is another thing traders make mistake, and this comes again in the position management. They always jump in with the dollar they have allocated. They jump in with the first lot. If they want to buy 1,000 shares, they say, okay, I'm going to buy 1,000 shares. The first time they see the move, they put in 1,000 shares, buy 1,000. That's not right. Or 50 contract. They need to allocate certain dollar amount and break it down into 2-3 different lots, and then scale in. So they don't do that. They just buy one shot. Sometimes the stock goes up like crazy and they make too much money, and sometimes they're just sitting and trying to get out at break even. So easiest trade come before crowd notices. That should be your technique. If you learn to identify the technique, the trade will come before the starts moving. And believe in singles, not home runs. A home run come, and sometimes you will get 100% return, but most of the time in option trading, if you're making 45, 50% return, 35, that's your single. So you keep taking single, 35, 40, 35, 40% return, and you do your analysis. What on average, how much you make. So if you make on average 40%, that's your return. So you make 40% return, you're happy. Home run comes sometimes, so that take care of some losses, and smooth and rising equity curve. So your equity curve should be rising at a 45-degree angle, not some zigzag up and down like crazy. It goes up, then it goes down, then it up, down. It's not some wild stock. It should be, ideally, it should be traveling at a 45-degree angle from left to right. Slide. So if you draw a trend line, I'll show you next time how your equity curve should look like. If you draw a line, a straight line, then the amount your portfolio is breaking that 45-degree line slightly to the downside, to the upside, but it's keeping it straight. So that should be on a weekly basis. It should be like that. So if your equity curve is not like that, it's volatile, then the things are wrong. Maybe the things are wrong. You're putting too much trade when you're not supposed to. You're putting too much dollar when you're not supposed to. So you need to take care of that. So watching your equity curve on a weekly basis is a good thing. So it should be like this. If not like this, then it's at least a little flat, tilted up like this or like this, but not up and down like crazy. So I'll show you next time. I'll show you the different equity curves. Okay, features of our swing option trading. So we have swing option service. And we provide real-time trade alerts. If you remember, you know, I provide real-time trade alert during market hours. I don't provide when the market is closed, so I don't do that. All trade alerts are sent through email during market hours, so you can buy at a specific price. I do provide a specific buy price, not some a range, a big range. I do provide targets. I call green, yellow, and red. And I do post the charts on a Facebook group. So if you're a member of Facebook group, you get the charts there. I do provide the charts through webinar, and I teach. And there's a Facebook group. There are 3,000 members on Facebook. You can join that Facebook group. And when you join, you get my 82-page trading system guidebook, which explains in detail. And then you receive emails, educational emails, 3-4 emails a week. So I try to cover many topics there. And then I hold webinar. So there's no shortage of profitable trades. I do all the homework, and you just trade and build your confidence, and you learn. So there are many traders who have learned and become independent. These are some of the testimonials. So now I talk to you about the strategies I use. Some of the strategy. So I use breakout strategy. I use breakout reversal strategy. So breakout strategy is when the stock is breaking out from some resistance, from some congestion. So when the stock is trading on in a congestion level in a narrow range, and suddenly it breaks out like Costco did today. So you need to pay attention, either breaking down or breaking up. So if it's breaking up, you go long. If it's breaking down, you go short. And then also you need to, again, you need to not only that, but you need to provide, understand the technical analysis, where you can enter, go long in that range. Where is that, what level it crossed that you should go long. So breakout strategy is like that. My favorite is breakout reversal, which is when the stock pull back to some support area and then bounces back up. So it pulls back and then bounces up and moves sharply to the upside. And the reason it's doing it, the stock pullback, there could be many reasons. The stock pullback just there was no reason of its own. Generally, the market was down, so the whole market was down, and the stock pulled back due to the market. Traders took profit, and now the market is good, and the stock is moving up. Or the stock had some bad news, and people exited, and now the new buyers have come in. Or the news which was previously there, they thought the news is bad, but the news is not as bad. The news is actually good. So when this is happening, I go long. So most of the time, this is what I do: breakout reversal strategy. So I look for the stock which have pulled back and making a comeback. That's a great way of making money. And this one, opening range breakout. So this I explain in every webinar, and I explain to you because there are always some new people. So opening range breakout. Opening range breakout means that, let's say there are 8,000 stocks in the market, and out of 8,000, your basket is 600, right? So you know that, okay, I'll trade 600 stocks. Out of this 600, I'll trade. So I put those 600 in a basket on my trade station. I cannot monitor all those 600 during the market hours, which one is moving up, which one is moving down. So what I did, I created some windows and put the timer on those windows. And I said that, okay, on this window, I put a 5-minute timer. So any stocks which are making a new high during the day after 5 minutes, please show me that stock. And the volume has to be good. So let's say 10 stocks come out of 600. Then, so I notice that and I say, oh, okay, these 10 stocks. So I take a look, cursory look at all on a day chart, and I say, okay, this stock is this overall where it's trading in a landscape. And if one of those stock is I'm already in, then I'm happy, and I'm watching it also closely for taking profit or adding more to the position. So that's one. Then after 5 minutes, then come the 15-minute interval. So the stocks move out of 10. There will be some stock which are still moving after 15 minutes. So they show up, and so it's good. So there are less stocks in that window. And then the 30 minutes later, there's another window where only 1 or 2 stocks will show up. So it means that even after 30 minutes, the stocks are still moving. So Pacific time, my time, right now Thailand time, around 9 o'clock. So market opens here at 8:30 and at night. At 9 o'clock, if some stocks are still moving, then it's good. Then finally, I have another window at 1 hour. So at 9:30, if the stocks is still moving, then that stocks is really good, because 1 hour is enough for all the news to come and digest. The market has to digest during that 1 hour. And if even after 1 hour the stock is moving, then it's perfect. So if the market is moving after 1 hour, then that's the one I have to take the trade. Let me just a second. Okay, just a second. Okay, so one person, I kicked him out. He was bothering me. Anyway, you see like that? How did I kick one out? When you have power, you can kick someone out like that. All right. So what I was talking, sorry about that. Breakout strategy, breakout reversal strategy, opening range breakout strategy. So I talked three techniques. Now I talk to you more how I do that. Okay. Now there is another 4 strategies I use, and this is also I use every day, and I will go into detail in this these 4. So gap up and gap down, gap up reversal and gap down reversal. So stocks are amid almost all of them, all of the stocks are gapping up or gapping down. If the stock gaps up 1 cent, it's called gap. But ideally not. For us, the gap should be at least $1 or so based on the ADR. So if the stock trades $2 in a day and it's gapping down $1, that's a good gap. If the stock is gapping up $1 or more and it trades $3, that's a good gap. So those are the gap stocks which I monitor during pre-market hours. So I'm preparing my list during pre-market. So in the 1 hour before market opens, I'm watching all the stocks which are gapping up and gapping down, and I make a list of all those stocks separated, gap down and gap up. And during market hour, when the market opens, then if you can program your system that if the stock price today, open price, is $1 and above the yesterday's close price, show me those stocks. So the gap window will show you the stocks. So now the gap up and gap down. So when the stock gaps up, where does it gap up? At what stage of in its cycle is gapping up? Is it gapping up at the beginning of the stage? Is it gapping up at the middle of the stage of its run up? Or is it gapping up after a major uptrend? Where it is gapping up? So you need to identify that gap, that stage of the stocks. So if you don't identify the stage of the gap, and if you don't identify the resistance levels properly, where the stock has gapped up, did it gap up above resistance levels or did it gap below resistance during market hour? What is the volume? What is the reason for gapping up? So if once you identify the volume, you identify the stage of the gap, the cycle, where the cycle is, stock cycle, you identify the resistance level. It has gap above resistance or below resistance. Then you are able to trade the shares. And Look for the if there's some event coming up right after a few hours, then it may not be a good trade. You may get caught like earning, and then you prepare your option chain. So when the stock is gapping up, I'm looking at the all doing all this and then looking at the option chain because I trade options. So I say, okay, options is good, the spread is good, the volatility is good. The stock is gapping above the resistance level. It is at the this stage of the cycle. There is a potential there. I have enough time. I can take the trade. So all these decisions, checklist, check going on. I don't have a written checklist. I used to, but now it's all in my mind. So you should have that. So gap up. Now gap down is opposite of gap up. So the stock gap down for some reason. There has to be some news. The stock gap down for some reason, and people traders are trading getting out during pre-market hours. And then when the market opens, they are getting out. So usually when the stock gaps down, it gaps down at some major support level. So if now your job is to identify if it's gapping down at the major support level or it broke the support, and what is the volume and what is the news. If the news is like accounting scandal, then the news could be very bad and the stock just keeps going down. If the news is suppose the CEO left and he was a good CEO and the stock will gap down, but then they realize, okay, there is another good CEO, better CEO will come. So the stock starts reversing. So it depends on the news. It depends where the stock has gap down, right? Whether it gap down to on a 50-day moving average or 200-day moving average. If it gap down to 200-day moving average and breaking, is there any other support? So all this analysis goes into trading, and then you decide whether to trade gap down in the down direction, or you trade opposite. So when you are, if let's say the stock gaps down and you want to take a trade to the upside, so you need to do your homework. You need to be in a position where you can identify that the stock gap down is at support. That's one thing, and it will not move down further. The news is not that bad, and the stock is reversing. So you switch your chart on a 5-minute chart or 15-minute chart, and then you see the continuous upward move. Continuous bars are forming on a 5-minute chart or 15-minute chart. 3 5-minute charts on a 20-minute chart. You see 4 5-minute bars, and the volume is rising when it's getting bought. So you know that the stock has bottom, and now you can take risk and go long. I mean, I do that all the time, but you have to be skilled in that. And another thing you need to understand in the gap down, the stock may gap down to the support and run up and then hit some resistance. So where is that resistance? Is the resistance far from your entry point? If the resistance is far from your entry point, then you take that gap down. If the stock is trapped between support and resistance, so you may get in at the right time at the support level, but then the stock bumps its head at the support, at the resistance, and then it stops, and then you are stuck. Especially if you have option open, then the stock will just do its sideway move for for days and days, and then you lose your time decay, a premium through time decay. So it's not a good way of doing it. So the stock has to reverse sharply. Now this gap up reversal is, I hardly do it. Gap up reversal when the stock gaps to some resistance level and then it pulls back. So the news was not as good as they thought, and the stock gaps up and then it reverses, form some kind of a pattern like a shooting star or gravestone doji or whatever, and then it pulls back. So gap up reversal, you need to take profit. If you are in the trade, take profit. Gap down reversal, if you are in a short trade, you take profit. Or if sometimes you reverse your position, you take a profit in the short position, puts, and then go long. So these are the 4 types of strategies. Now I show you the chart of how the gap look like on the chart on at a different phases. So there are three types of gap. One is called breakaway gap, the second is called runaway gap, and the third is called exhaustion gap. So try to understand where the breakaway gap occurs, where is the runaway, and where is the exhaustion gap, and which gap is the better one. So breakaway gap, if you look at this chart, this is the pacing pattern. The breakaway gap is happening here. The stock is moving. Runaway gap is happening here. The stock move further. Exhaustion gap is happening here. So let me explain further. So now we know there are three types of gaps: breakaway gap, runaway gap, and exhaustion gap, right? So three types of gaps. So remember it. We go through these three types of gaps now. So what happened with breakaway gap? So the breakaway gap happens at the beginning of a significant market move. So what happened is stock is trading in a narrow range. It came down for certain level. There was some bad news, or the market was down, and now the stock basis makes a basing pattern. So it's just moving sideways, moving sideways, moving sideways, and then suddenly there is a news. So that news came, and the stock breaks up from that congestion level and move up. So when it moves up, it forms that gap. So this is what happens here, breakaway gap. So this gap, so the stock was trading at the range, right, up and down, up and down. So the big boys are buying it. They know, they believe in the fundamentals, so they are acquiring it here. But for you, when you see this break from the congestion level, this is the first entry point you get in. So I love this kind of break. So recent example, WDC made too much money via calls. So when the stock gaps up after forming this, you time your entry and get in, and you will make good money. And you need to know where to exit. All right, for swing trading. Uh, so different exits for different kinds of trading. So for swing trading, the exit is different than the position trading, and the exit is different than for long-term trading. Yeah, it's being recorded. I will send you the link, recording later tomorrow. All right. So this is the breakaway gap. So pay attention to the breakaway gap, because this is the first time the stock is telling you that I want to break away. I want there is a news, buy me. There's something good going on, and I am buying. Buy me. So this is what the stock tells you, and this gap needs to be above the resistance. So you need to identify the resistance level. If the resistance is crossing the resistance and breaking, and the volume is good, get in the trade and stay in the trade. So what could happen? The stock gaps up. You see the stock gaps up, and then it moves up, and then it can pull back. So it can pull back, and so this would be your second entry. The second entry could be right at the support. So this is the low of the gap is the support. So the first support is the low of the gap. The second support is the high of the previous day candle. So this is, then it becomes a range of the support. So support is not one price level. Support is the range zone. So this is where it's called demand zone. So this is a demand zone. This is the support zone. So if the stock pulls back, suppose you missed your entry here, you can buy on a pullback. If you bought here somewhere in the middle, suppose you didn't buy right at the open, you bought somewhere in the middle, this is your second time to buy more. So that's why I say you need to add more to your position. Don't just buy 1,000 shares in one time and then wait for a pullback, and then it's pulling back, then you're getting out, whereas you should be adding to it. So your thesis is wrong. You don't believe in your trade. The stock can pull back to the low or the high of this, and even then it's good and it will go up. So the quality of the breakaway gap, it's happened beginning of a significant market move. Its major basing pattern is completed, right? or it breaks a trend line. So if there is a trend line, if you draw the trend line, it's breaking that trend line, and has a heavy volume. The volume has accelerated compared to the previous 14, 15, 30 days of the volume. So just take the average of the 30-day volume and compare it to that day gap day volume, and see if it's above average. So let's say during last 30 days, the stock traded on average 800,000 shares. And today, right at the 30-minute time interval, 30 minutes has passed and it's already crossing 800,000 shares. So what is it telling you? It's telling you that the stock is being bought. And by the time the day is over, the volume could reach to 3 million, 4 million. Whereas during the past 30 days, the stock was trading only 800,000 shares. So that's your clue. Volume is there. The stock is gapping above the congestion zone. It crossed the resistance line. If you look at some news, the news is there, and things are looking good. So you initiate your trade. And these gaps don't get filled so easily. They don't get filled easily. So what happens? The filling of the gap is right here. If it touches this high, they don't even come back because what happened is those who miss this trade on a gap day, they are waiting. They are waiting that, oh, this stock gaps up, now I need to buy this. So they are watching. As soon as the stock touches the low, their buy program kicks in, right? So their buy program kicks in, and if their buy program has more buying pressure than the sell program, some other guy who's selling it on this gap up, if the buy program has more power, then the stock will not even come down to close the gap, and it will just continue its up move. So this is your zone, you have to remember, and this is called breakaway gap. This is the most important gap, and this is what I trade mostly. Okay. So runaway gap. So runaway gap is the second gap. So what happens in a runaway gap? The runaway gap is the second gap. The market is already trending to the upside. There was a gap before, or did not have a gap. The market has already traveled some distance. So let's say the market formed a base around 100, and it's trading at 100, and it gapped up, and now it's trading at suppose 106, 107, and then it gapped up again at 208 and 9. So that's a runaway gap. So why the runaway gap? Because there's more positive news came in the stock, and the stock is gapping up again. So those who bought at 100, they are still holding it, they are making money. And those who did not buy, now they have further catalysts to buy. They have further reason to buy. So they buy on the second gap. So that's what is called a runaway gap. And I'll tell you why it's called measured gap. So there's another name for that. So market leaps forward. So market moves up. There's another catalyst for the market is announced. So there is some more good news. And the stock is, that's why the stock is gapping up, but the volume is moderate. So volume is moderate compared to the day when the stock gaps up on a breakaway gap. So that's the difference. And major gap. So the major gap, because what happened is it's happening at the middle of the trend, and you can calculate the target for this gap, and I'll show you how. So let's say you see this chart. So this is the basing pattern. The stock made a low right here, right? It's some low here. This was the breakaway gap. Now the stock gaps up here. So calculate the distance from here to here, and then add to the gap. So if it traveled from the base to the runaway, before the runaway 10 points, add another 10 points. After the gap, the stock has the probability of running another 10 points. So that's your crude way of finding out where the stock is headed. So if the stock has traveled 10 points before the runaway gap, add another 10 points, and it will run 10 points more. So after, when the stock reaches 10 points, then you look for the clue of a topping pattern. What is it telling you? Is there a doji? Is there a shooting star? Is there some reversal pattern going on? And you take your profit or exit from the trade. The game is over. And I'll tell you the third one, the exhaustion gap. So the exhaustion gap. So this is, we talk about runaway gap. Now finally there is one more exhaustion gap. This occurs at the end of the trend. This is where people get caught, and this is where you need to exit. So it's called exhaustion gap. So the stock is exhausting itself. So what is happening in exhaustion gap? It happens at the end of the market move. So the market is traveling from, let's say, 100, and now it's at 125, and it gaps to 126, 127. So that gap could be exhaustion gap, because the market has already traveled so much. So it's not at the initial stage. So when the market is not gapping up at the initial stage or at the middle of the stage, that is not a good sign. You have to have a very solid reason for going long, such as a major move came, or the volume is high. So something major is happening. If the major things is not happening, the move will fade, and it will come down. The stock will come down and close the gap. And even after that, the significant correction can happen. So this can happen. The stock exhaustion gap. See, breakaway gap happened here, runaway gap happened here, exhaustion gap. The stock gaps up, and then it just sits there. There's nothing happening. There's nothing happening on the gap up, and the stock just goes on the sideways. So, and you will be trapped. So in other words, when the stock is gapping up, try to identify at what level, what stage the stock has gapped up, and then take action. Because the pattern it will form is called island reversal top. So what it does is the stock just keeps on moving on the sideway, and then one day it just gaps down. So it create an island. So you see this island is created. So this breakaway gap on the downside, this to the upside, this breakaway gap happens to the downside, and the stock just gaps down, because all the news, etc., everything is over now. They are done with the stock. So all these big boys, those who bought here, they are the one who are selling here. The retailers are buying here, and then when the stock gaps down, then all these people who bought, they are the one who are selling it. So these guys, they are still making money. They are getting out. These guys are making too much money. All these guys who bought at this level, they are all losing it, and they panicking, and they are exiting also. So everybody is exiting it, and this stage keeps continue, and then the stock comes back right here. So this island reversal top happens, which has this characteristics. After exhaustion gap, market moves sideways. So if you are caught in an exhaustion gap, then you will see the stock is moving sideways. That's not good. Narrow range, up and down, and it forms a resistance. And then it can have a gap down day. So that is a breakaway gap to the downside. So opposite is happening now. So it's not good. Especially not good when you see Western Island reversal top. So this is really bearish. So what happened? This is an exhaustion gap. The market has been moving, and finally it gapped up, formed the exhaustion gap, and then gaps down. Third day it gaps down. So this is called Western Island reversal top, and this is more bearish because they say that the lows did not touch the high. The low of this did not touch a high. They are all. If you look closely, there is a gap here. There is an island here. This is an island gap here. So this candle is not touching this. This candle is not touching this. This candle is not touching. Or this bar is not touching any of the candles. So this is a reversal. So if the stock gaps up and then gaps down, it's a highly bearish. So you have to pay attention to your long side. Okay. So we have a swing option service. Those who are not my member, they will receive an offer for 287. The published price is 337. So if you like what you see, for 287, you can trade with me for 90 days, and you can cancel anytime. So you will receive an email. Keep an eye on the box for the email to come for the offer 287. All right. And I do have a 6-month coaching program, which is going to be 8 months. I said 6 months, but it looks like it will be 8 months. So if you're interested in an 8-month program, 6 month to 8-month program, then send me email and we will talk for 75 minutes and go over that program. All right. There is a cost to attend this 75-minute session. It's not free. Okay, so now I'll show you some charts of the previous few days. As I'm traveling, so I have limited charts, but I do have quite a few charts. It's already 1 hour, 10 minutes gone in this webinar. So another 20, 30 minutes. So I'll show you the charts quickly just to give an idea of what I do, what I trade, and how I trade. So this is an Apple chart. We traded Apple long, and we are still long. Apple, you see, this kind of told me that there is a support right here, because there was support here, and then it made another hammer candle, and then when it gapped up and made this kind of based on my analysis, it gave me the signal that I need to go long on Apple. And this is what happened. Apple just kept going up and up, and it ended up here. So you see the journey started here, and it's right here. So Apple is still long and is going up. So Apple today went up, and I went long here. After gap up, gap down, it formed this little tiny candle, which formed right here at this support. So I said, okay, I can take risk. The reason is that this was a little hammer, and then this is a little hammer, bullish pin bar. So I said, okay, I'm gonna take risk and buy Apple, because I found 185 as support, and today it moved up, and it's right here. This one, Baba. So Baba traded here. You see this gap down, but this is a bullish candle. This candle, you again in trading, you have to based on your experience, you have to take some judgment, some decision. Indicators are not telling you, but based on your experience, you say that okay, I could go long on Baba. So if you look on the left side, when I look at the left side, I say this is the support zone, so I would go long, and the candle was a bullish candle because the Baba opened here and it closed here. So it was reversing to the upside. So go long, it's still long, long, right? Baba is still long, moving up. You see how this candle became like this over here. It's still holding, right? You see this, it came back down here, it's still supporting this. So 185, I mean 165 is a very strong support for Baba. And now Baba is sitting here. So this is what Baba did. 165 to 200. So trade is closed. Baidu, again, the Baidu, I prepared the chart on 24th of April. On 24th of April, I was sitting somewhere in Bangkok, floating market. I'll show you some other day charts. Floating market. I think I was there. Maybe I was in China. I don't know. So the Baidu trying to cross 200-day moving average, and it pulled back, formed a hammer. This is a strong signal I look for in my trade. When the hammer is formed, I look for the trade, and especially the second day confirmation comes. So when the second day confirmation comes, I go long. I enter here. It depends when the candle is formed. Sometimes I initiate my position here. Otherwise, position is initiated here. And this is the result. You see, from here, Baidu, we close the trade. We don't have Baidu anymore. So this candle gave the signal. Baidu just flew all the way, earnings, everything included on. Caterpillar. So this Caterpillar fell down sharply. Then it started moving showing you the sideways candles in the support zone. So this is your support zone. So it's telling you that I'm okay to buy call. Don't buy short. Don't buy short me. Don't buy puts on me. Go long on me. And you can, as a trader, again, you have to make judgment and then go long. And this is what happened to Caterpillar. We exited with profit in Caterpillar. You see, after this move, it did not violate 200-day moving average and rocketed upward. CLX, I just prepared the chart of CLX. It's just on a radar because of this hammer candle, so I put it on radar. Let's see what it does. If it starts moving up with the volume, I'll go long on CLX. COP, we traded COP just based on this candle, bullish pin bar, and it crossed. When it crossed the bullish pin bar, I went long on COP. And for COP, the other stocks needs to be moving up in the crude area, and the crude is moving, the oil is moving. There's a news going on, and the oil is touching $70 a barrel, etc. So when all this is happening and the crude stocks are moving, and you spot one crude stock which you like, you go long. So COP exited, done. Costco. So yesterday Costco broke this range, and I went long and closed the trade same day. It hit the target of 199 plus. So this trade is gone. Before it was giving this bearish signal, but when it crossed this candle, crossed this, it gave me the buy signal, and I went long on Costco. This is DAL. I prepared the chart. So airline stocks are moving like United, Delta. So Delta looking good. So it's bouncing off 200-day moving average, and it looks like it's gonna go up. So if it crosses 50-day moving average, it will even become better. And the target somewhere is 56. So Delta is moving up along with the United Airline. So all good. Dish Network, I made money on Dish. So when Dish fell down and formed this hammer, forming hammer, I went long. I bought the calls at 360 and sold at 410. Send the alert to members to buy calls. So we bought the calls right here and sold it next day. Not next day, after 2 days for 410. So made some money. The Federal Express, so this is a chart, we traded Federal Express. So what I did, I look at this candle. This was a inverted hammer candle. I said, okay, this is bullish. And then the counter attack happened. So I went long on FedEx and closed yesterday with profit, big profit, 200-day, I think, per contract. So FDX closed just based on this. There's no indicator here, no indicator, just this, no indicator. Yeah, see that FedEx? So enter here, exit here. KSS, we bought KSS long, we did twice. We bought here and then we bought here. We added to the position. We bought here and then we added more to this position, and then KSS we closed yesterday because of Macy. So when you are in a position, let's say in KSS, and another department store, Macy, came up with the earning, and the stock is going crazy. So Macy is going crazy because of earning, and then KSS follows along. It's time to take profit on your trade because of Macy is helping your stock. So Macy earnings help KSS, and it touched 65. I was watching in pre-market. Send the alert to members. We will lock the profit. It's touching 65. Let's see if it goes to 65.50. This high, and we locked great profit on KSS. So just based on this pattern, no indicator here. KSS, we locked the trade, lock gains here. You see reversal. Macy was moving up, KSS moving up. And how do I know what's the high of the KSE and it's time to lock the profit? Because I was watching pre-market action. So when I was watching pre-market action and the market opened, I locked my profit in KSS. This is Meli. Meli gap down on earning and is giving bullish signal. So I went long on Meli. I bought shares. I look at the option. The option was wide. The spread was wide and expensive. So I bought some shares. So don't need to buy. If you have money, if your portfolio, if options looking bad, you can buy some shares. So Melly is giving a bullish signal right here. MPC, we traded MPC based on this candle bouncing from the support and crossing 50-day, and we made money on MPC, Marathon Petroleum. So just based off this trend line bounce, 50-day moving average, MPC closed. NVDA, this is a important stock. Everybody trades NVDA, Apple, Facebook. So this NVDA, we usually trade long, sometimes trade short. So NVDA hit 260 and then it gapped down on earning. So on a gap down earning is tricky, right? So it can continue going down or it can go up. So it went up next day, but then it gapped down. Now this looks like this support is filled. This support is holding the support of this gap. So watch NVDA if you're not long. Pay attention to NVDA for going long. My target is 275 for NVDA. NXPI, I trade NXPI. I send the alert to my end of day service to go long on NXPI, and it gapped up on earnings. I don't have a position on NXPI, but I send the alert to my end of day members. This CINA, so I have a CINA position and it's not doing good right now. I bought CINA on this day when it gapped down and reversed, and then it gapped up. Here I bought calls, so I'm still holding CINA calls, and it's right now it's losing. But keep an eye if you don't have CINA. CINA is going up because the stock gaps down, form the hammer. It's not an ideal hammer, and then it gaps up. So as long as it trades in this range, it's still bullish. So CINA is still bullish. So pay attention to CINA. SPG, so SPG looks like bullish. It held 50-day moving average. It gapped up and formed this white candle. So SPG looks like it's going to reverse to the upside. Square, we traded the Square and we made a lot of money. So this is what Square was doing. It was trapped between this support line and the 50-day moving average. So I was keeping an eye on the Square. And I said, okay, I'll pay attention to Square and go long. So I went long, and this is what it did. It just kept going. On earning, it pulled back, and then just kept going. Every day, it just pulled back. I mean, kept going up and up and up and up. And now we don't have any more position on the Square. Yesterday, it was being bought again, but because it has already moved so much, so I ignored it. But otherwise, yesterday there were buyers. United Airlines, as I mentioned, is doing good, and all other airlines are doing good. So we have a position in UAL. Keep an eye. My target is 72. This somewhere here. I'll exit on UAL. WDC. So this is a trade I talked to you about. You see breakaway gap. This is what I was talking to you. So this is the congestion pattern, right? You see this congestion and then sudden gap up. So this is a breakaway gap. Look at the volume. This is breakaway. So I bought calls and I closed right here. Yesterday I closed it around 86 plus because it moved 3 days. Continuous 3-day move. My rule is if the stock continuously moves 3 days, it can take a breather next day and then it can move. So I took a profit. So 3 up day move is good enough for me for my option trading. So made a lot of money on option call. I can go back. If it pulls back, I'll go long again. Win. Now win is on my radar. It looks like it's going back up. So keep an eye on the win. YY, we traded YY, made a lot of money on YY. So this is what I saw, support at the trend line and went long, and this is what happened to YY. Just kept going and going. Now it's not doing much. So my stock charts are complete. I'm showing you quickly the market indices and where the resistance are. It's quite obvious. So you can see the resistance. Market is in a reversal to the upside trend. So it's going higher. So Let's look at this 11th May chart. I show you today's chart. So just a progress, 14 May chart, 16 May chart. So Dow Jones formed hammer on the February 9th low level and it's moving up. And here is the resistance around this level, 25,500 plus. So this is the resistance zone. So it has enough room to move up. Here is SPX again, hammer, moved up on 11th May chart, 14 chart, move back, 16, now it's fill the gap, and here's the resistance level around 2800. So 2800 is the resistance for SPX. NASDAQ, again the hammer, moved up, kept going up, gap down again yesterday, and then moved up. And this is the resistance level around 7200 for SPX. Russell is facing a multiple top, and it looks like it will break. So multiple tops is facing, but it broke. See, on 16th of May today it broke decisively. So keep an eye on the Russell 2000 as your key market. So Russell contains 2000 stocks and the low price stocks. So they are the ones who are moving now. So low price stocks are participating right now in the rally. So Russell broke the multiple tops and it's going up. So keep an eye on Russell. All right, so the webinar is almost over. If you like to join my swing option service, send me an email and keep an eye on your inbox. You will receive an email for the offer of 287 for the quarter instead of 337. And if you're interested in a 6-month strategy session, send me email. You know how to contact me. It's a 75-minute session, and we will go over the 6-month trading session. It's actually going to be 8 months instead of 6 months. All right. Thank you very much. It's late, but it's early morning over here, and I'm going to have fun. Thank you. See you. Bye.